thank you for coming tonight. Matt, are we off? Are we on live? Cool. So whoever's online, thank you for showing up tonight. Appreciate that. So if you were coming for the cross-country mortgage road to homeownership seminar, then you're in the right place. If you weren't coming for that, you got free pizza, you can leave now. Okay. All right. So let's start with who we are. Who is cross-country mortgage? Because, you can get a mortgage from a lot of places, right? You can get it from a bank. You might have heard of the term a broker, credit unions, private banks, private investors. We're a direct mortgage lender. We're known as a mortgage banker. So if you think about a traditional bank, like let's pick Chase, right? Chase Bank, you can go into Chase Bank and you can get a car loan, a boat loan, a school loan, a CD, a money market, credit cards, checking account, right? All of that stuff. And also you can get a mortgage there. If you were to think about Chase and their mortgage department, their division that does mortgages, that's who we are. But we're that on steroids. We're at our peak, we were 10,000 people. We're down to probably about 9,000 people, right? And we are really a nationwide brick and mortar company that is in every state, including, I think we do have one in Hawaii. So if you decide to move to Hawaii, we'll get you a loan there. 8 of the last 12 years, we have been, we are in Fortune 500. We're one of the fastest growing lenders in the country, right? And we are now the largest New York State lender. Pretty cool, right? We have to take a very common sense approach to our underwriting. In the mortgage process, every bank reserves the right to say, well, this is the guideline, but this is our guideline on top of that. It's what they call an overlay. We go straight to what the automated underwriting system says from Fannie Mae. If Fannie Mae, if we run our loan scenario through Fannie Mae's underwriting system and it says, Santiago, he's W-2 employee, I just need his W-2s for the past 2 years and 30 days of pay stubs and 2 months bank statements, then I really don't need to ask him for, a blood sample, his tax return, and everything else, right? We just go common sense enough to make the loan work, okay? Fastest turnaround time, we're going to talk about why it can be really fast and faster than normal. And really, honestly, every product to fit every need. We're not a one size fits all. We're a lender like, again, if I go back to Chase and not to pick on them, but Chase has Chase's product line. That's what they do. If it doesn't fit that box, then they can't help you. So we've got our own product line from Fannie Mae, Freddie Mac, and all that. And then we've got every other product. So if you were, believe it or not, we've got one product that if you were one day out of bankruptcy, I could still help you. I hope that's nobody in the room or online, but that is a possibility. Okay. So the goal today is education, right? And educate you about some of the benefits of home ownership and kind of walk you down the buying process. I'm going to talk about the market a little bit. Okay, and identify some of the common misconceptions that we may have when we purchase our first home. Like if you subscribe to like a Susie Orman, right? And I'm not taking anything away from her, but if you listen to her, she'll tell you typically that you're not ready to buy a home until you've got enough money saved to put down 20%. You've satisfied all your debt and you got 6 months mortgage payments left in reserve. Now, if that were the only way you could buy a home, then we would be in trouble because no one would be buying a home, right? So I want to just get past some of the misconceptions and tell you why it's still a great thing to be a homeowner. And then we'll explain some of the products and the basic do's and don'ts about the qualifying process. To me, the earlier I can educate you on what not to do, not so much what to do, but what not to do, the better, okay? But really tonight, I just want to talk about this for a second. What if everything that you believe to be true about your mortgage, your home equity, and even your college and retirement planning weren't true after all, because this is what you believed? When would you rather know about it, now or later? Of course, the answer is now. Yeah, thanks for the audience participation. Yesterday, for sure, 100%. Okay, so we're going to have a discussion too tonight, right? And this is going to be a discussion about creating wealth and eliminating debt through a properly structured mortgage plan. I'm going to say it again. I want you to think about what I'm saying there because it's kind of a counterintuitive statement. I'm telling you that you can actually create wealth and get out of debt by getting into debt, because isn't mortgage a debt? But most people only think of a mortgage like a debt. And it is a debt, but it's much more than that. It's really a financial instrument. And if I can teach you to harness the power of what it is as a financial instrument, I will promise you that I can show you how to. Has anyone got school loan debt? Nope, you got some school loan debt. Okay, so it's not that much. Well, good. Does anyone want to someday maybe buy a second home? Okay, so I'm going to show you how that could be possible by just getting your first mortgage. Okay. So some of the basic advantages I'll give you of home ownership, right? Being a homeowner allows you to invest in an asset that is going to grow over time. Let's take a car as an example. We all know that the day we roll the car off the lot, what happens? Except for a second, if it's a used car these days, right? But you're right, it really loses its value, right? So a home is about the only appreciable asset that you can buy. Yes, you can buy gold and you can buy maybe some expensive jewelry and you can buy artwork, but you can't live in those things. So this is the most practical thing you could spend your money on, that you would purchase and have debt on, that would actually give you a return. Now, the national average for the past 100 years has been a 6% return in appreciation on real estate. Okay, yes, there's been times when it's been down 15% and up 25%. The national average for 100 years is 6%. Long Island has been averaging 7% for 100 years. Last year in New York State, not Long Island, last year it returned 11.32. So if you came to my seminar last year, you already made a lot of money. How are you, Lance? Nice to see you. Second advantage is that it's going to provide a stable living environment for your family, right? I mean, it's not like the landlord is going to call you one day and say, hey, listen, I'm sorry, Linus, that we're selling the home and you're going to have to get out next month. What do you mean? I just fixed up this whole apartment. No, sorry, it's not your home. We're going to talk a lot about this, that we're going to show you how to, create a great tax benefit and build wealth through purchasing a home. And of course, it's all about gaining the fulfillment of home ownership, the American dream. Okay, can you see well enough? Because we can move you a little bit if you'd like to, because I'm in your way. You sure? Want to move? Yeah. Okay, so why don't we have you, yep, right in the middle. Cool. What is your name? Oh, Miriam LaBranche. How are you, love? So glad you came. So let's talk about, and you're going to have to move your head just a hair. Yep, you're cool. No, just slide half. You're good. You're good. So let's talk about homeownership's impact on a person's net worth. All right, watch this statistic. Did you know that the median average American net worth is $121,700? That's like a lot of money. That's median. That means just average of everyone, right? But here's the thing. Of that net worth, 68% of it is in the form of home equity. So the first thing that should trigger you to understand is that unless you own a home, you don't have home equity. Because here's the fact of it is really, a homeowner's net worth is really 40 times greater than that of a renter. You see, the average American homeowner doesn't have a net worth of 121, it's 255. While the average renter is only 6,300. That's more like what you would probably think it would be. So when you blend it together, you get the 121.7, right? So I say, if you compare this 255 to that 63, which would you rather have? Time to buy a home. All right. Jerome Powell, probably heard of him. You may know him, you may not, you should know him. If you're in the market to buy a home, you should start to listen and hear what this person says, okay? Who is he? He's the Federal Reserve chairperson, right? Many people call him, and everyone who's been in that position, the second most powerful person in Washington. Why is that? Because markets move on just the words that he speaks, right? If the Fed makes a decision to move an interest rate, the market automatically reacts. And then this man comes out about 2 hours later and discusses what their reasoning for it was, and the markets will change again because of what he says. So Federal Reserve consists of 7 members who set monetary policy. Like what are interest rates look like in America? And that makes up the FOMC, which is the Federal Open Market Committee. Here's the good news. There's no test tonight. I'm just giving you background information. I think it's important just to know this because this person cannot kind of really have an impact on your future a little bit, at least while you're buying a home. So what's the Fed doing? I mean, have you taken a look at every time you go to the pump and how much more money it costs to fill up your gas tank and just buying groceries, right? And dining out and whatever, right? It's like, hey, we got an issue here. So what's the issue? The issue is one thing and one thing only. It's inflation, right? Inflation is the issue. Okay, so what the heck is inflation? I mean, if you give it a definition, I'll give it in the simplest form. What inflation is. Inflation is too many dollars chasing too few goods. See, I'm 60 years old. And when I was about 8 or 10, I would go down to the candy store with a $1 bill. And back then they had candy stores. And I could walk to a candy store with a $1 bill, come out with 2 hands full of candy, stuff my pockets and probably have another quarter left over. Today, if I could find a candy store and I walked in with a $1 bill, I wouldn't even walk out with a stick of gum, right? Or maybe a half a pack of gum. And that's the point, right? It's your dollar no longer buys the same amount of product that it used to buy, right? So Federal Reserve has one policy, fighting inflation. That's their number one function, is to fight inflation, okay? Because inflation is to interest rates what kryptonite is to Superman. Takes away all the power, okay? So the target rate for inflation is 2%, as measured in the consumer price index, the producer price index, the price consumption expenditure, all of these different things that the government uses to monitor, what we spend our money on and how much it costs us, right? We're currently standing at about a 5% inflation rate, which is off the highs of what was recently 6+%. So it's starting to move in the right direction, but that's the highest level it's been in nearly 40 years. So if we've really experienced 4 decades of really low single-digit inflation, which if you start to track interest rates, again, my whole career, I got into the mortgage business 36 years ago. If you kind of track my time in the mortgage business, interest rates have pretty much done this. It's been a nice run. So when we see, 6% inflation, we just know it's just not sustainable, right? Because how long are you going to be able to really afford even like your rent costs? And, and then you top your rent and you want to go out once in a while, and you want to buy something at Home Depot, wherever it is, right? And you want to go out to dinner and it's like, man, there's nothing left over, right? So we know that it's not sustainable, and we know that the Fed is doing something about it, right? And what they can do is they only have really one tool in their arsenal: raise rates enough to slow the economy down to get inflation in check. So there's a little bit of pain that we've had to go through before we get to the good stuff, right? And we've seen the pain. You've all felt it, right? Everything costs more money. Even your credit card debt has gone up, and if you bought a car recently, that's gone up. If you happen to be unfortunately having school loan debt, those rates have gone up. So, well, because of COVID right now. So so far so good. Yeah, absolutely. There you go. Well, that's but even 4% is 4% of debt that you don't want to have to pay back. If your mortgage rate was 4%, I'd say have a different story about that, right? Because there is a difference between that type of debt, what I would call bad debt, car loan debt, credit card debt, school loan debt is bad debt, versus good debt. If you could really call good debt, good debt is mortgage debt. Why is mortgage debt good debt? It's typically a lower interest rate, and it's tax deductible, and it allows you to buy something with that debt that appreciates in value. All those things I talked about, right? Okay. But let me go back. But we may very well be heading into a recession. There's all the telltale signs. If you start to watch, and you might want to start watching this a little bit like CNBC and listening to the market news about the industry, there's a lot of indicators that say we could be heading into a recession. There's a lot of talking heads on Wall Street. if you put 100 economists in a room, you probably get 50 to say we're going to have a hard crash landing and recession, and some say a soft landing, but virtually no one, very few are now saying we're not going to have a recession. There was a little bit of back and forth on that, but now I think everyone is seeing the T and they're like, hey, we're going to probably have a recession here. So why, if we're going to have a recession, is it still a great time to buy? Let me show you. These bars here, this is time, 1960, 65, 70, 75, 80. I know you may not be able to see that as well online, but this is time. And these darker bars are times of recessions, right? And the white line is the S&P Case-Shiller U.S. National House Price Index. So this is housing prices. So every time you'll see in the 1960s, prices didn't go down. They kind of stayed flat, a little bit higher in the 70s, but you see they did increase during the recession, increased in 75, increased in the 80s, increased in the 90s, right? And in 2000, they increased a great deal, right? The only time home values went down was during the mortgage meltdown crisis of 08, right? And that was not for any reason about the economy. That's because this industry that I'm in, we're selling bad products. Did anyone ever see the movie The Big Short? You did. Cool. In The Big Short, they explain exactly what happened. But that was a time when you really needed basically two things to get a mortgage. You needed a social security number and air in your lungs. If you were breathing, you got a mortgage. And those mortgages were really bad mortgages, right? And I'm proud to say I didn't get involved in those mortgages. But look at what happened right after the recession happened. Look at how it corrected and look what values did. And if you look at the last recession that we had, 2020, look at how values have increased and look where it's headed. So recession is not necessarily a bad thing if you're a home purchaser. Here's the next part about why a recession is not the worst thing. Mortgage rates typically drop in recessions. Okay, so the most recent recession was in 2020. Okay, and interest rates came down from, and they were already low, they came down from 3.75 to 2.75. In 2010, it came from 6% down to 4 7/8. In 2002, they went from 7 3/8 to 6 3/4. 11 down to 8 3/4. This is the year I get into the mortgage industry around here, right? Interest rates in the early 80s, believe it or not, were 18%. How did anyone buy a home back then? Well, it's all relative. Home prices back then, you could purchase a home even on Long Island for about 40, 50 grand. But look at how much that dropped in that recession, right? So, and prior to that recession, 1980, rates went from 16 down to 11. So you see, there's always an opportunity. So when I tell you that if you're going to purchase a home, have this mindset that you marry the home and you date the mortgage. We can always refinance the mortgage. But if you don't get into this game of home ownership, there's going to come that time when you get priced out of the market. So if you can afford, and we're going to get through some of this tonight, right? But if you can afford to purchase a home now, I suggest that you buy now. I've been preaching buying now forever, and it's been the right thing to tell people. For every seminar I've done for 20 plus years, I always tell people the time you bought a home yesterday, but you can still buy today. Because I'm going to tell you right now, if you came to my seminar last year, like I said, you'd be thanking me. You had a much lower interest rate. You wouldn't have to worry about refinancing, and your home would have already went up in value by 11 or 12%. Okay, so that ship sailed. You buy now, interest rates are more like 6 1/4. If I can show you where rates would be when they get down to 5 or 4 3/4, you're going to be real happy camper about that. And that will happen. So you marry the house, you date the mortgage. Got it? Let's talk about what the housing forecast is. And this is the housing forecast according to a lot of people, including me. It's not gospel. It's just a perception, but I want you to think about what I think this market is about to bring us, right? So this spring market, which we're just now in, we typically see more inventory come out. I mean, right now, Miriam, you're just, it's tight out there, right? It's so hard to find a home. I mean, she's been on so many pre-approvals and poor girl, but your home is out there. I promise you, your home is out there, right? But typically we do see coming in the spring and summer markets, more inventory come out, okay? But it's still going to remain tight, right? Because there's just as many homes as come out, more buyers come out, right? So, but it's not going to be like 2021. Were you looking in 2021? Good, because if you weren't looking in 2021, what you need to know is there were people lined up like 40 deep. If Christine was still here, she'd tell you it was chaotic. No one even wanted to be a realtor because you had to work so hard. I mean, how do you choose between 40 people who all bid over the ask price? Right? So here's your little window of opportunity too. Interest rates have not come down yet, and all the buyers that are going to come are not out yet. But so you're ahead of the game. I mean, you're being really proactive and smart by getting your education done. And then we're going to talk about how you get ready beyond just the education, so that when the time comes that you find that house, we are ready to pounce on it. Okay. So, and this was, rates may have one more tick in them from the Federal Reserve, but I want to tell you something. If I say that, I know that you may feel that too. You've seen that we've raised the Fed funds rate from 0.25% back January of last year to 4.75% today. So it's been a 4.5% increase, sometimes 0.5%, sometimes 0.75%, sometimes 1/4. The most recent increase was only 1/4%. And there's predictions that they may pause at the next meeting, or they may actually increase one more time. Either way, I really feel like the worst of it is over. So we're on the other side of interest rates. If I had this seminar 8 weeks ago, I'd be telling you that the interest rates are pushing 7.5, and now they're 6.25. So we're on the other side of it. Okay. But well, I just told you that, right? Marry the home and date the mortgage. This is your little window right now. Okay. Home values are going to stay strong though, as they do in most recessions. And here's what it is. Even if we don't hit a recession, what moves anything to go higher? High demand and low inventory, low, right? And that's what we have. Low supply, high demand makes the price of anything go up. If you had a used car and you were ready to just sell it back in during COVID, you would have been like, you could make money on your used car. Rents have increased an average of 32% in New York State and in New Jersey from 21 to 22. Just seeing the turn on that, but it's still high. And trust me when I tell you, renting is not, and you probably know this already, is not what it's cracked up to be, right? Interest rates, 2024 predicted to drop significantly. Prediction, it could be lower than what I'm sharing there, but 4.75 to 5 to me, very sustainable and very affordable. Remember that mortgage rates are deductible. So even though you might be paying that rate, like if you're paying 4% on your school loan, Linus, it costs you 4%. I'll show you why a 4.75% mortgage or a 5% mortgage is not really 5%. It's less because it's taxed. That's wrong. That's 100%. I'm going to get to that. So I'll let you stay with that thought. That's the SALT cap. Okay. State and local tax. That's only on property taxes. It's not on your mortgage interest. Your mortgage interest is not capped. Only the taxes are. So I'll get to that. I'm glad you know about that. Oh, there you go. We'll talk about that. Okay, cool. I love it. So housing markets primarily driven by millennials. And millennials, as by definition, are born between 1981 and 1996. Raise your hand if you are a millennial. 1, 2, 3 millennials. Okay, so here's missed it by that much. The oldest millennials are turning 42 years old this year, amazingly. And they now surpass the baby boomers as the largest generation of homeowners. See, I'm a baby boomer, right? Old guy. And at one time, baby boomers ruled the world. We spent the most money on the most things, that we were the most, influential group. And then there's not us anymore. It's Gen Xers and it's millennials. Okay. So forecast mid to single digit appreciation still in rates, right? Okay. Demand is going to stay strong. Why? Because of these millennials. Let me tell you a bit more about millennials. So here's a chart of the median age of a first marriage. median age of first marriage. The red, and this is red, this red chart is for women and the blue line is for men. If you look around 1960s, 50s and 60s, women were getting married, and all the way up until really the 80s, women were getting married in their very early 20s on average, and men even in their still early to mid 20s, right? And you see as time went on, it increased, right? So this is where we're at now, basically. People are getting married later. So the millennials are not like boomers. They're waiting longer to not necessarily have a relationship, but to get married, right? And if you do it the traditional way, and I know sometimes there's not no tradition anymore, but if you do it the traditional way, you get married and then you typically will form a family, have children. And guess what the next natural thing is to do after you form a family? Move out of the apartment, move out of mom and dad's house and buy your own darn home. So this is why the demand for housing is just really beginning to peak, because this is your competition. Millennials are now forming families between 35, 40 some odd years old. They're just coming to the market now. So don't ever fear that when you purchase something, a house, when you purchase a home, that it's going to plummet. Oh my gosh, why did I buy now? Because I showed you all the reasons why it's not going to, right? And listen, we're in Long Island, 150 miles long, widest part's about 38 miles, and we got over 3 million people sitting here. We're not making more land. They're not dredging and bringing more sand in here for housing anyway, right? You got the Pine Barrens, so all that land is not usable. So we're in a fixed community of finite amount of homes, and we're still growing. As much as people say people are leaving New York, you know where they're not leaving? Long Island, because it's still a great place to live, all things being equal. And as I said, inflation is on its way down, right? So we kind of really peaked it around 2022 when it was pushing over 6.5, right? And now into 2023, we're really pushing below 5%. So that is gonna, as that goes in check, so rates go as well, okay? But here's what I want you to know. The last recession we had was 2007, okay? And the inventory back then in 2007 was 4 million homes for sale. So there's plenty of inventory then. And look at over the years from 07 till now, how the inventory has dropped, right? So right now in 2023 in America, there's only 980,000 homes eligible for sale, but that's not even the end of the story. Here's the real story. Of the 980,000 homes for sale, about 40% of them are already in contract. Okay, so they're not really technically on the market, but they don't come off that inventory number until they close. So the truth is that there's really only about 578,000 homes for sale. That's our actual inventory. Okay, so this has been typical inventory, right? Between 1 and 1.5 million has been the typical inventory. And now we've just seen unprecedented stuff. This was COVID, of course, right? And everyone bought everything possible. And now in 2023, it started to head down again. So the inventory is not getting better right now. Okay. And that's why it's still time to purchase, right? So the last time we had that bottom cycle in interest rate in the market, home values really plummeted. It really came up from 2012, right? There was an 8% appreciation rate just in the year of 2012. And at that point in 2012, there was 2.4 million homes on the market. Just think about how much more appreciation you might see when you got less than just about 500,000 homes. And you're one of those homeowners, right? Because again, this is 2012, right? That was the inventory there, 2.4 million, and home values went up 8%. Let's talk about mortgage rates. Mortgage rates will affect your purchasing power, right? Give you an example. If you borrowed $500,000 at 6.25%, the mortgage payment, just principal and interest, not taxes and insurance, about $3,100. If it happened to push up to 7.25, payment goes up to $34.11. So there's a $332 differential in the payment just in 1%. Okay. In order to get you back, let's say this is the max you qualified for was $3,079. In order for you to get that payment back to $3,079, you'd have to drop that purchase price from $500 to $451. So it knocks $49,000 off your buying power. That could be the difference in the house you really want or the house you settle for, right? I think we're past the fear of this, but I want you to see that the other way too. If we go from 6.25 to 5.25, we're dropping the payment by $332. And we could very well see this go by more than a full point drop, right? Here's what you should know though. For every 1% drop in interest rates, it's going to add 5 million qualified borrowers in America to the market. So your competition, you see what I'm saying to you? Like right now you got the window because rates haven't dropped yet. The frenzy is not as bad as there is a frenzy. It's not as bad as the frenzy has been and probably will be. So the more prepared you are to get all your ducks in a row, the better chance you are getting the home you really want, right? Okay. Let's talk about Fannie Mae, Freddie Mac. Ever heard of those terms before? Yeah. What are they? Well, they're really nicknames for the Federal National Mortgage Association, FNMA, and the Federal Home Loan Mortgage Corp, nicknamed Freddie Mac. School loans are known as Sallie Mae loans. That's just a nickname, right? What? Yeah, yeah. And I have an Annie Mae, but she's just my aunt. I'm just kidding. So typically, if you're a first-time home buyer, you could purchase with as little as 3% down. If you're not a first-time home buyer, then it's a 5% down payment. Okay. If you're putting less than 20% down, you have to take on an additional insurance called private mortgage insurance, which is temporary and lasts only until you've got about 20% equity in your home. And then you can just, without even refinancing, you can go to your servicer and have that removed. FICO scores with this program have the minimum score of 620, can't go below 620 on that loan. And they will do 1 to 4 family homes, co-ops, and condos. That's what they do. Not commercial loans, it's only residential. This is for a different discussion for a different season. Seller concessions is where if it were more of a buyer's market, not a seller's market, you might be able to go to the seller and say, hey, I need a little bit of help. I want to buy your home, but I'm short on closing costs. So maybe we can build into your sale price a little bit of closing costs and you give me a concession. You have too much competition for that to even be an option. Okay. All right. There are higher loan limits than there ever been. Every year they come out with the median home price, and we're in what they call a high cost area here in New York. So with just, if you were a first-time home buyer with just 3% down, you could purchase or take out a mortgage up to $726,000. Now that would be a little crazy, but we'll look at the increase that happened from 2012. And that's just a result of how high the median home prices have gone, right? And with 5% down, because we're in a high cost area, crazy as it sounds, you could put 5% down and take out $1 million+ mortgage. Now you wouldn't eat. You wouldn't have enough money for anything else. You'd be a slave to your home. And I never think that that's a good thing to do. Okay. Talk about mortgage payments versus rent payments. Mortgage payments are typically higher than rent payments, but that gap is beginning to close because we see that shelter costs have gotten really expensive, right? Did anyone get a rental increase? Yeah, I mean, that's what happens, right? And the landlord is like, hey, opportunity. And by the way, in fairness to landlords, their costs went up too. Payments consist of principal and interest, right? This is strictly with the mortgage itself, right? Principal is what you borrowed, which gets paid back in each payment, right? And every time you pay back some of the principal, it's like a forced savings. It's making you pay back some of what you borrowed. So it's like putting money back in your pocket, but you don't really physically see it. It goes into the equity of your home. Mortgage interest is typically tax deductible 100% for loan amounts below $750,000. I'll get back to your question. there is something here called a SALT tax cap. State and local, is that right? Good. So ready for this? It's only for 3 more years. That's kind of good news. They may bring back the alternative minimum tax, and that's always precluded high earners. But a lot of people, I think, I don't know if that's going to be good or bad. You're right. No one really knows. So let's just only stay on what we know. Right now, there's a cap on your state and local taxes. What is that? That's your state income tax. And unfortunately, we're in a state that has income tax. What is the current state tax rate? 8.625? Yeah. I think it's 8.625, right? So when you make $100,000, 8.625%, $8,625 is going to New York State because you live here. If you were in Florida, how much is that state tax? No, how much? It's 0. You know why people are flocking to Florida, Tennessee, New Hampshire, Texas, Delaware? That's why. But that's not the end all be all, because you got to live in Delaware. And it's not, and there's other things that come with that. Like you listen, we live in New York. We're in a high cost area. We should be the highest earning place too. And we are for the most part, right? But mortgage interest is only capped at $750,000. You can tax deduct all of that depending on your income tax bracket, depending on the rest of your story. Like for your average homeowner, it's going to be tax deductible. Okay. But investing in a mortgage means leveraging the money in just about the only, as we said earlier, the only appreciable asset that you can buy. Right? Rents are at the highest levels in history, and none of that comes back to you. None of it, right? Rent payments give you a 0% return on your money. You want to go back to that? You want to take a picture of that? Okay, go ahead. Got it? Okay. So I say owning instead of renting has its advantages. Right? I'm going to show you that some of the down payment options that we can set up for homeownership with low and by the way, any veterans in the room? Any veterans? Anyone know a veteran? Anyone know anybody who knows a veteran? Okay. So listen, the best possible loan is a VA loan from the Veterans Administration because that loan requires a 0 down payment and no PMI. Yeah, it's a great loan. And we should give good things to veterans because they deserve it, right? But here's a sample of rent payment over time. Right? So let's pick something like, listen, you don't get to Taj Mahal even for $3,000 or $3,500, right? But just think about this. If you paid rent for the next 5 years at say $3,000, you're paying $180,000 to your landlord. That's sickening to even look at. I know, I'm sorry. I'll try to get rid of that screen quickly. So home ownership as an investment is an investment in your own future, right? That property is likely going to increase almost every year, right? And we'll make sure that we're not making you overfinance, because I certainly don't want you buying a home with your last pennies and having to live off of tuna fish and cat food and coming to a seminar for free pizza. Okay. Remodeling may also increase your home value. I mean, I put a beautiful backyard pool and deck and built-in kitchen. I know that I would never sell I know that it's probably worth $150,000 more than my neighbor next door just because of the backyard. Plus, I love it. Right? Fixed rate mortgages are the way to go right now. The only time adjustables make sense if you're doing really high-end financing, or if it's not affordable, we know rates are going to come down. As I said earlier, this is kind of redundant, but with each payment, you are building equity because you are paying into that down payment, the principal, right? And the tax breaks we talked about. Okay. And here, this is for you. You're always going to consult a tax accountant before you talk to me. I'm just a voice, right? I'm just trying to give you a little hope here. Are you out? What firm do you work for? Oh, Deloitte. Terrific. Are you on the island here? Or are you in the city? Yeah. Oh, that's good. Perfect. Good for you. Okay. So I say stop investing in your landlord's future, invest in your own. Your landlord loves you. And here's why. Let's take $3,500. And again, $3,500 in rent for 7 years, 84 months of rent is a crazy number of $294,000 for which you get just a roof over your head. And a full home. Again, if we're going to apples to apples, I mean, yes, you could rent an apartment, you could rent a small, but if you're trying to be a homeowner and own a home, the equivalent to own a home is at least $3,500 to rent a home. All right. So let's take a hypothetical purchase of a home, right? Let's learn about the return on the investment. So let's say you buy your first home. It's a modest home, right? It's not the Taj Mahal, but it gets you in the game. And I hate to say that that's a 525 home. That wasn't, it used to be a 225 home, but it's all relative. It is what it is. So you were able to put down a 5% down payment on that. It's $26,250. You're now borrowing $498,750, 95% financing. This mortgage payment is going to consist of 4 things, right? Cost of closing, right? Between your closing costs, your moving costs, your attorney fee, and all the New York State mortgage tax and title insurance and appraisal and credit and all that nonsense. Probably into it for about 22. I might be a little on the high side, but I'm not off by much. Add them together. You got a cash out of pocket of close to 50 grand. You with me? Okay. Right. So when we had, again, the attorney and your moving costs, you're at, let's just say for this discussion, you're at $50,000 cost to purchase a $500,000 home. So about 10% in total, right? Okay. The monthly payment for that home, that specific home, would look like this. That's the mortgage payment. Let's assume taxes are 12 grand, modest home, $1,000 a month. Homeowners insurance, right? And homeowners insurance is to make sure that, God forbid, in a fire, could be replaced. And then this PMI, which is temporary, right? About $115, and that could change depending on your FICO score, but I'm assuming that we're all got good FICO scores and we're all going to, improve our FICO scores. Yeah.
Is PMI like a percentage? Or is that
No, it's funny. It used to be a percentage. Back in the day, it would be for 3% down, it was that percent. For 5% down, it was that percent. For 10% down, it was that percent. Now it goes by the down payment, the FICO score, 2 buyers or 1 buyer, if you're a previous homeowner or not. So they're looking at profile of people to say, okay, we're going to reward the people who really demonstrated a good use of their debt and didn't abuse it. And so PMI has gotten a lot cheaper for higher FICO scores. And it used to be what you just said, but it's no longer that. So there's a lot of numbers that go into, a lot of factors that go into a PMI cost, right? There's only 6 PMI companies in the whole industry. We have all 6 of them. So I have no allegiance to one or the other. I just pick the cheapest one every time we run it. And every time we run it, we run all 6. And we just give you the cheapest one because they all insure the same way. So this total payment sounds like, holy crap, it's $4,361. Let's assume at today's interest rate, that's 6.25, right? Let's assume a good FICO score, 12,000 taxes. You got the scenario. Well, okay. That's not terrific, but let me finish the story because you guys all got a sad face on. Let's talk about tax deductions. Okay. I already pre-did the math, so I wouldn't sit here with my calculator. Okay. The annual interest on that particular home at 6.25% is $31,006. The taxes are $12,000. The total number would be $43,006, but you have this SALT cap tax. So you can only take 10 of this 12. So you're not going to be able to take $43,000 off your tax return. It's capped at $41,000 because it's the 10 of this plus the 31. You with me? Got that? Okay. So I was ahead of you. Just, you were ahead of me, I should say. So let's just say, for argument's sake, if we're good earners and we're married or, have 2 incomes, we're in at least a 33% tax bracket between state and federal. So again, doing the math, I take 33% of the tax write-off, divide it by 12 months. And if I just show it to you on a monthly, it's about $1,127 out of that $3,400 payment that you get back. So let me show it to you. if you rented and that mortgage and that rent payment's $3,500, your tax benefit is zero. Yes. So that's how I would feel. Okay, zero tax. Versus if you owned your home and that mortgage payment is definitely 800 and change higher. But every time you made that mortgage payment, in theory, you didn't see it in each month, you get back $1,127 because of your tax write-off. So the effective payment is not even $3,500. Effectively, it's more like $3,234. Okay. Don't forget the fact that it's going to, on average, appreciate a percent number. Now, here's the last part to that, right? This is how much of the principal you paid in the first year. Remember, on a 30-year mortgage, it amortizes and you pay principal and interest, principal and interest, principal and interest. And every single month it changes a little bit more principal, a little bit less interest. You see it on your statement going, how come it's only that? But it is what it is. So in the first year, you have that $41,000 of tax or $31,000 of mortgage interest, but you also have 58, almost $6,000 in principal that you paid back. That's the same thing as saying I put $5,844 in my pocket. I just can't get it back until I sell my home or refinance it, right? So that comes out to $487 a month if I just divide that by 12. So I want you to just think through the whole picture. This $3,500 cost you $3,500. This $4,300 cost you $3,200, and out of the $3,200, you get $487 of that number, and it's in your pocket. Does the landlord say, "Hey, you've been a real good girl"? What's your name, Diane? That's what I said, Chris. So, Chris, does the landlord say, "Hey, Chris, you've been a great tenant this month. Here's an extra $500"? No. Got it? All right. Let's talk about that same home again. And let's go way below the average appreciation of 6 or in New York State was last year 11 and change. And let's say it only goes up, and I'm going to do a 9-year scenario. Let's say this thing only goes up. Let's say this year we got a good one, pop at 5%, but let's say it only goes up 4% for the next 9 years. That $525,000 home, 9 years from now, and you can believe it or not believe it, I'm telling you, this is what's going to happen. It's going to be worth $754,000. And if I did this seminar for you 9 years ago, because I was doing them then, remember my base home price was about 300, and you would have never thought, because it blew that number away. So here we go. So just remember the number. You purchase for that, that's what it's worth. Now I'm going to show you an amortization schedule. Remember the first year I showed you that you've got $31,000 of interest to write off, and you pay back $5,800 and change in principal, right? This is the combined principal and interest on a monthly basis, on an annual basis, right? So again, 9 years worth, right? And you'll notice in 9 years that the principal grew each year, right? And the interest went down each year, but it's still a good tax deduction. But look at the balance of the mortgage. It went down to $430,000. So here's the magic. Your equity in just 9 years. You amortize the loan down to $430,000, and the house is now worth $754,000. Let me do the math for you. It's a $326,000 return on a $50,000 investment, which is almost 650%. That's why homeownership is magic, and that's why if you said to me, "Hey, I've got $100,000 in school loan debt. Why should I buy a home now? I'd rather just pay off the school loan debt first." Oh, man, borrow $50,000, buy a damn home. And in 9 years, I'm going to give you $324,000, take $100,000, pay off the damn school loan debt, put $200,000 on your next house. You got your closing costs and you're good to go. And now you're on to home ownership and home ownership and home ownership. How many homes do you own now? You're on your third home. Your first home cost how much? And your second home? Different story. You down, but you were able to buy that for maybe cash even when you. Okay. But yeah, But the point is, if you bought everything in New York, 400 would have been 600, would have been 800. Like, what is that $400,000 home today worth here in New York? The one that you sold. There you go. I don't want to. But does this make sense? Okay. I lost my. Okay. But maybe you say, well, Bruce, what if I just took 50 grand and I decided to put it in the market? Maybe I should just wait to buy something. You see this right here, investor.gov. If you go on to investor.gov and click on the compound interest, you can get this exact model. You can plug in any number you want, but let me just show it to you because I did the math. Start with the same $50,000. Now, remember, you're still renting, but you save that, what, $800 a month because you're renting versus owning. But $50,000 that you start to take the same 50,000 you're going to use to buy a home and you put it into the market. And you contribute every month that extra, say, $8,000 or $1,000. Let's say you put an extra $1,000 into that investment. And let's say over the same 9 years time, and I give you a great interest rate of return of 9%, 9% on your investments, that will return you $264,000. Still renting. No tax deduction. No personal satisfaction of home ownership. Can't have a dog. Sorry, can't. The landlord says no dogs, no pets. Right? Which would you rather have? 264,000 or 324? It's a rhetorical question. You don't have to really answer that, but you understand. That's a no-brainer. So when someone says to me, you need to save more money to buy a home, I'm like, no, 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 you got it all wrong. You have to get into debt to get out of debt to gain wealth. It's that first thing we talked about. Do I prove my point? Okay. I'm going to land the plane quicker, a little quick, but I know it gets late and tired. But let's just recap. If you purchase with a 30-year fixed rate mortgage, for the most part, you've locked in that cost of your mortgage for 30 years. We know that if you rent, one guarantee, over 30 years time, that rent is going to only increase. Landlords don't decrease rent. As a homeowner, as I told you a couple of times now, it's a forced savings because you have to pay back principal and you gain interest. So you get the home appreciating in value, right? You're paying down equity, paying down interest, and you're building equity, right? As a renter, the only guarantee is that you built equity for the landlord, right? Either way, just remember this. You are paying a mortgage. It's a matter of, are you paying your own mortgage or are you paying the landlord's mortgage? That's really what it comes down to. Okay. So what you want to make sure is that you are prepared to purchase your home. You want to get at least pre-approved before you buy a home, or maybe there's something better, right? A pre-approval is going to tell you a couple of things. It's going to tell you that, hey, am I ready? Listen, I've sat with a lot of people over the years and said, listen, you're probably 6 months away. You got to save a little bit more money. Maybe you pay off that debt. We got to build that FICO score up, and I'll work with people. I've worked with some people for a couple of years before they purchased their first home, and that's okay. Right? It's going to tell you on a pre-approval how much you qualify for. Right? You've had that inquiry from me a few times. Do I qualify for this? Do I qualify for that? Do I qualify for that? How much money do I need to purchase the home? What's the payment going to look like? Do I need to repair any credit now? I mean, those are the things that we find out right up front, right? Got to know your numbers, right? Because today, the average home that comes out on the market is only days away from being sold. Therefore, a typical, like you can go online to, let's pick on a different bank. You can go online to Rocket Mortgage or Wells Fargo's online, thing, and you can plug in some numbers and get pre-qualified. And you can take that to a realtor and they're going to be like, that's garbage. See you later. You can go to a traditional bank and you can go to somebody like me and get a pre-approval. A little bit more due diligence. I'm looking at some documents. I'm running credit. I'm making sure that the numbers seem good, but I'm not really stamping it with an approval because it hasn't been to underwriting. The best thing we could do for you is to get pre-committed. We get a full credit package approved by underwriting, right? So what happens with that is we call that our fast track, right? Fast track is going to give you an edge because it's already been underwritten by our underwriting department. So that means loans approved pending finding a home that fits that parameter. we're going to talk about doing yours that way. Because I think maybe if I get you fast tracked, it's a stronger offer. Okay. I may need you to do a couple more things. Not a lot. You give me all the documents, just you're gonna have to sign some disclosures, not a big deal. All right. But I think we're gonna need to get you that place. So you keep losing out and I don't want you to lose out. What?
You get pre-approved or
You can get both.
test drive too soon?
No, never too soon. Well, yes, yeah, no, 100%. You know, this is good. Great question. So if you know you're 5, 6, 7 months away from actually looking heavily at a home, let's just get the typical pre-approval done. So at least you have a starting place. I'm still going to give you the same numbers. I'm going to still help you figure out where your purchase price is. But until you're going to make some hard offers, you want to try to do that fast track within about 90 days. So nothing expires, right? Because I'm telling you, it's a hard approval. There's going to be basically 4 conditions off of a fast track once I issue it. Find a home and go to contract, do an appraisal on that home, get a clean title and get your homeowner's insurance. Theoretically, I can close you in about 21 days once I'm fast tracked. But credit documents, mortgage documents are only good for 90 days. So if you're going to be 6 months away from it, listen, I have done fast track for people who just couldn't find a home and had just re-update the fast track, which we could do. So you can do it. I'm not going to discourage you from doing it, but if you ask the question, it's a very good one. That's what you'd want to do. Okay. So, I mean, New York State, here's the thing too. Remember, cross country is a nationwide lender. If you were to purchase a home in Florida, they don't have these on or about closing dates. They have, this is your closing date. And it's usually about 30 days from the time you go to contract. So in cross country, they fast track in Florida, everybody, because you got to be ready to rock and roll. So even if I have you ready, here's the good news. If you make an offer with a fast track, many times I got to get on the phone and explain to the other realtor what the heck that is, because not many people do a fast track. And I explain it's not a gimmick. I've actually done the homework, got this loan, a fully approved package. All they got to do is those 4 things. We're going to close your home. And I could close you in 30 days. Sometimes people are like, I want to wait till the school year is over anywhere. I want to wait till the end of the summer and spend my last summer there. I want to get my holidays in. That's okay. But if you have that kind of an offer, there's going to be those options, those opportunities when someone says, look, I just got a job transfer. I want to sell this house yesterday. I'm your buyer. Okay. That's what the certificate looks like. We're actually revamping it to make it look a lot more official than that. There is a first-time home buyer program. I think you asked me about this program. It is, you cannot have, it's a Sony May is another acronym, State of New York Mortgage Agency, only for first-time home buyers. What constitutes a first-time home buyer is only owned and not owned in the past 3 years. So you could have owned a home 4 years ago, sold it, and then be eligible 3 years later to get a Sony May loan. It also requires only a 3% down payment. They also give you 3% back as a grant up to $15,000. So for instance, if you bought a $500,000 home and put down 3%, which is $15,000, New York State gives you a forgivable grant of the same $15,000. The problem is it's limited to income limitations. It's a lot harder to qualify for. Like they don't give much allowance on the debt to income ratio. It's difficult. When you fit into it, it's great. When you don't fit into it, we don't bother with it. Okay. Requires a minimum FICO score of 620. Not just that, you have to have your credit be seasoned. You have to have at least 3 open trade lines that have been open for 24 months. So if you've got minimal credit, you're not going to go Sony May. They are stricter on the guidelines for underwriting, as I told you, and they are income and sale price limits, right? Typically the rate is lower. It's not a lot lower right now. What is Sony May's rate? About 5 7/8, something like that? Yeah. So I will tell you this too. As the Fannie Mae rates start to come down, this becomes less popular. Right now, the disparity is only 3/8. When rates were 7.5, Sony Mae was probably 6 1/4. So there was a much bigger reason to try to fit into that. Yeah.
How often do those rates change? Daily?
This is once a month. Everything else changes daily, sometimes twice a day. Depending on I just dated myself, depending if Jerome Powell is speaking that night.
That would be a daily thing.
Interest rates, yeah. Oh, daily, yeah. Well, just think of it. It's the market. What is stock market? What happens in the stock market? You can see it. You can see a rally at the end of the day. You can see a fall off in the end of the day. You see one stock go way up, go way down. The bond market is the market also, right? There is a maximum sale price. Oh, there you go. That is the current rate, 5 7/8. Okay. And if you, oh, by the way, here's what's amazing. So this sounds all great. I want that 3% down to 3% forgivable grant, but what they do is they take the rate from 5 7/8 up to 6 1/4. So give and take.
Down payment 5.5, down payment.
6%. Okay, so it's still only a 1/4% differential. So again, it's not the worst. It's not the worst. It's great if you qualify. Okay. All right. Home Ready is another first-time home buyer product. Again, there's income limitations, but it'll take the normal Fannie Mae product and probably reduce that by at least a 1/4% on the interest rate. Okay. I'm not going to get too much into that. Now, this is a series of products that we've got across country. They're proprietary to us. There's other companies that also do these. A non-QM, which stands for qualified mortgage product, is anything outside of Fannie Mae. Fannie Mae, Freddie Mac have their qualified mortgages. They're noted as qualified mortgages, right? These are different. So if your cousin was your niece, is she your aunt or your cousin, Christine Dixon? Or just a friend who you call cousin? Okay. So lady that was here earlier, she's a realtor. Now, realtors get paid on 1099. They're independent contractors, right? Certain sales jobs are 1099. That means you get the full gross of what you earned, but they take no taxes out. And then you're responsible for spending quarterly taxes and making adjustments, making estimates, and then you reconcile at the end of the year. So what if typically people do, what Linus, when they do get 1099, they beat that. Yeah.
She has no idea what this is.
Yeah.
She didn't pay taxes.
This is bad, right? So look, so you got to be responsible if you're 1099. But I will tell you about this program. This program, these are all higher interest rates. But let's say for realtors, for your friend, if she didn't screw up with her taxes, we get to use the 1099 income, not the adjusted income. Just like I use W-2 income. So this is kind of cool if you were, you wrote off everything, but you really were hiding stuff anyway. You wrote off everything that even when you went out to dinner with your friends and you wrote it off. 1099 program. We've got other programs that will only require 1-year tax return. So maybe you just came through COVID, you had a horrible 2021 and you bounced back in 2022. If you've been in business for 5 years, I can just do a 1-year tax return program. Staying? Okay, cool. There's something called an asset depletion. In fact, this gentleman behind you is my team lead, Joe. He is what I would call a guideline guru in all of this product. Like he figures out everybody if they qualify into this product or not. Bank statement program. So you're not showing me any tax returns. You just show me 12 or 24 months worth of your deposits in a bank statement. So maybe you are a garage, like a service station, a lot of cash, a salon, a lot of cash. So bank statement program, show me your last 12 months, show me your last 24 months. Let's see the deposits. Let's see what your percentage of ownership is, right? And then we derive an income from it. Again, back in the day, like I told you, 2008, when the mortgage crisis came, when you needed just, a breath under your mirror and a social security number to get a mortgage, those were bad programs. These programs are much more responsible because they're still going to check your bank statements, your credit. Like there's a lot more that goes on, but we know that there's certain people that just don't show the whole story. And that's what these are for. So I'll get past all that, but those are good products. And this is my plug for my realtors who are not here tonight, but you can go anywhere to find a home. You can go online, you can go Zillow, you can go for sale by owner. Bottom line is, if you don't have your own realtor, you're going to end up inheriting one because almost every home is listed. That's a good home. Okay. So you may as well find the right realtor and plug into the lady that was here earlier. His friend is dynamite realtor. Okay. But if you have one, you have one, and that's cool. Here's your steps in the home buying process. It starts with finding a good agent, a good realtor. And again, if you're not working with an agent, give us a call and we'll get you to one. You got a good agent. Kathy is a hardworking lady. Got to find a lender. I happen to know one. That's a joke, everybody. Got to get that pre-approval or really the fast track. You make your offer. Let's assume your offer is accepted. And now you're going to get a home inspection. After that home is accepted, hire a real estate attorney, sign the contract. Now you're ready to apply for your mortgage. The mortgage go ahead. No, I'm done. Go ahead.
Just a question about like the pre-approval on the fast track. So like, me and my wife were like kind of like dipping our toes in, kind of looking at what's available.
Yeah.
But we're kind of like planning maybe like buying towards the end of the year.
Yeah.
So, for like this pre-approval, like let's say we try to get pre-approved now.
Yeah.
We don't finally get the bike or nothing works out.
No harm, no foul.
How does it affect the credit if we like get past the days or
Yeah,
whatever? it is,
yeah.
And then we have to
It's a really good question. So if I get you, let's just use a traditional pre-approval because you're maybe not going to fast track like you were asking, because you're not going to buy to the end of the year. So we give you a traditional pre-approval so that you can at least go and view homes. You can't even view a home these days without a pre-approval. So to answer your question, if you knew that you're that far out, when I do the initial pre-approval, not the fast track, I do a soft pull of your credit. I don't do a hard pull. Then there'd be no effect to your credit. And even if I did a hard pull the first time, and then let's say the credit runs out in 90 or 120 days, and you're still months away, I'm not rerunning your credit. I can update your pre-approval with just an updated pay stub and a bank statement. I don't need to rerun credit because I am the bank. When you get real serious, then we decide to maybe do your last hard pull. I won't do another hard pull till you find a home. There's no reason to do it. Good, yeah, 2 to 5 points. So even if I did a full hard pull of your credit, it's only a 2 to 5 point hit to your FICO score. A lot of people are under the misconception it's way more than it's not, right? So the mortgage requirements are like kind of like the 4 legs of a table. We're going to look at your income and any random order. Income, assets, credit, and appraisal of the house. Those are the 4 things that matter the most on the mortgage approval, right? And they're all equally important. There's not one that's less important than the other. So you got to get all those ducks in a row. Okay. The mortgage process starts with having a contract to sale. Once you got your contract to sale, you've already done all the preliminary application work on the pre-approval or pre-commitment. So there's not like outside of signing disclosures, there's nothing more for you to do except for maybe you got to update a pay stub or a bank statement, something like that, right? So we start the application, the formal application. Now we send the appraiser out to the house to make sure it's worth what you paid for it. We've finished processing the loan. We send it to the underwriting department. Again, if it's pre-committed, it goes right back to the same underwriter that committed it the first time. It's pretty cool. So it's not like a new set of eyes on it. It's like same person is underwriting the pre-commitment. Get your approval, you're in pre-closing. Maybe there's another, maybe you got to show me one more bank statement, whatever it is. And now we're ready to get your homeowner's insurance and now you're ready to close. Yes. No. Let me turn that back on you. An appraisal is typically about $500. You don't sign the contract and the seller says, I'm not selling to you. I found 2 other people. You just spent $500 on a house you're not going to purchase. The only thing you're going to do before you sign contract is a home inspection, but not an appraisal. You'd be throwing money away. Now, if a home inspection costs you $400, $500, $600, and you turned away from that home because you found out there's a lot of stuff that trained eyes saw, that was the best money you've ever spent. So don't sweat that. But you don't want to ever throw money into an appraisal on a home you don't have secure contract on. That makes sense? Okay, well, that's a risk that everyone takes. Now, if you do a traditional contract in a normal world, the normal mortgage world, the normal environment, normal real estate environment, you always have a clause in there that it's subject to appraisal. Today, your competition is going, I don't care if it appraises for 10 grand less or 20 grand less. You have to waive that contingency sometimes. It's not always. So now you run that risk. right? So if you're a person who's only putting down 3% or 5%, you're really at risk. Now, what do we do sometimes? You call me. I try to not being recorded. I try to get an answer for you a little bit ahead of time, kind of sight unseen. I can kind of give a little bit of guidance there. We could talk about that another time. Okay. It's a real good question though, because it's crazy market. Waiving their contingency, not just the appraisal contingency, the whole mortgage contingency. You dealt with that. Yeah. So it's a crazy market. It is what it is. It'll get normal again. It'll get normal again. Okay. But credit is probably the single most important piece of that whole process. Credit really affects everything about your life. It affects the rate you're going to get on your mortgage, but not just on your mortgage, right? It affects the rate you would get on a car loan or a school loan or credit cards. Credit's important, right? Qualification, the amount you qualify for and your debt ratio is important to credit because you get a little bit more leniency with higher FICO score on your debt ratio and what you qualify for. The cost of PMI, as you asked me the question before, can be higher or lower depending on your credit, right? As I mentioned, your car loans or leases are higher or lower depending on your credit. Even in your home insurance and even life insurance, they do credit, right? And even if getting a job, many companies reserve the right to run your credit before they hire you. So credit, what is it? It's an analyzer. Credit is an analyzer. It analyzes your ability and your willingness to pay back debt, right? The credit report itself is going to reveal a lot of different things about you personally. Your current financial obligations, your late payments are going to show up, unfortunately, on your credit report. Unusual circumstances. You got Bill Smith Jr., and Bill Smith down the road, not related to Bill Smith and Bill Smith Jr., all have commingled credit. It's an unusual circumstance. We can get that cleared up, but we do see that sometimes, right? Bankruptcies will show up on your credit report. Judgments and liens and charge-offs and collections all unfortunately show up on your credit report for 10 years. And then FICO scores. FICO scores. Everyone's heard of the term FICO scores. I got my FICO. Can any of you really tell me what a FICO score means or is? Yeah, that's a good answer. Yep. So it's really about, here's what it really is. The FICO score predicts statistically your chance of becoming 90 days late or more on any of your debt. I'll say it again. Your FICO score is a predictor that predicts how likely you are to go 90 days late on any of your debt, any and all of it. Why does anyone care about 90 days late? Because in the mortgage world, when you start to go 90 days late on your mortgage, we also have to start the foreclosure process. So that's what that's about. So there's your answer. It's a predictor. Statistically chance of you becoming 90 days late or more on a mortgage, right? Each score is specific to each bureau. We use 3 bureaus: Experian, TransUnion, Equifax. All 3 different models, 3 different scores. We don't average the scores, we take the middle score. If you got 2 bars, we take the lower of the 2 middle scores. The scores range in the mortgage world between 300 and 850. That was your classic FICO scores. There are people who tell me, who come in and say, I have a 900 FICO score. You don't, you have a FACO score. Mortgage scores only go up to 850. The higher the score, the less the odds are you're going to default. And these scores are specific to that time that I ran your credit. If you were like me, family lived out west for many years, we would just run up our credit during the month to get air miles. I always reconciled it. I don't remember the last time I paid interest on a credit card, but I certainly have run up thousands of dollars on them. But I used credit to my advantage. I used that so I got free air miles. And if you're smart, you can do it that way, right? So here's the odds, right? If your FICO score is above 800, only one person out of 1,485 people have the risk. It's not that you will have the risk of going 90 days late. But look at how this drops off. These are still a high FICO score. Look at if a 799 FICO score, statistically, you got 1 in 649 person chance of being 90 days late, and look as it goes. So you go below 620, 1 in 15 people statistically is going to be 90 days late. That's why Fannie Mae stops it right here. And they also price adjust your rate, your PMI and everything based upon the lower FICO scores. So it always pays to get that FICO score higher. So if for you, I'm sure you probably have good credit, but maybe you don't. And I'm not saying you do or don't, but it's running that credit ahead of time, like early intervention. So that if I know there's something like that, sometimes we can find a way to help you get that FICO score higher, right? Here's the 5 things that mainly count. Your payment history is a really important component of your credit history, but it really only accounts for 35% of the overall FICO score. This is the one that gets most people. See, 30% of your FICO score is how much you owe in relation to how much you have available. That percentage is your usage. So people have come to me over the years, over the many years, and said, listen, I did this ahead of time. I knew we were going to come and meet with you, Bruce. So I decided to cancel 5 of my credit cards. I didn't have balances, but I thought that was a good thing because I didn't want you to use it against me. I'm like, you just shot yourself in the foot. Because again, this model that reads is not a human. It's like an idiot savant. It sees what it reads and it reads what it sees. It doesn't know that 5 weeks ago you had 10 credit cards for 100 grand in usage and only used $5,000 of it. So if you took all that available credit card use and knocked it down to one credit card with a $5,000 limit and a $5,000 balance, then statistically, you're using 100% of your available credit, and you just shot your FICO score by at least 100 points. So remember in the beginning, I told you I'm going to show you some do's and don'ts. That'll be a don't. Okay, the types of credit in use account for about 10% of your FICO score. The length of time, and well, new credit accounts for 10% of your score, and the length of time you've had credit is about 15% of your FICO score. So there's certain tricks of the trade we can do. Like, let's say you just don't have a lot of seasons credit, right? And maybe you got a mom or a dad or a relative that's got seasoned credit and would allow you to go on that credit, that specific credit, let's say it's a Visa card, and go on as an authorized user. And you could boost your FICO score with things like that, right? But there is a tool, if there is a tool that we have that can help you boost the FICO score, right? But you have to have the money, the additional money to do that. So every time we run credit as a full, it's Joe, Wayfinder is only when you do a full report, not a soft pull. Okay. So if we're happy to do a hard pull of your credit, there is something called a Wayfinder that we can show you, like, okay, if you do these 2 or 3 actions, we can boost that FICO score statistically this much. So it's just good to know, right? Here's your do's and don'ts. So when I finish with this, then take a picture. Okay. Here's a do. Get pre-approved so you can make a strong offer. Really better than that is get fast track approved. Be thorough and honest on your loan application. Trust me when I tell you, we're going to find out everything. It's worse than going to the doctor sometimes. Okay. We won't take any urine or blood samples though. Another joke, and no one's like, come on. Continue to pay your rent or your mortgage if you're already a homeowner, and any of your loans and credit cards on time. I know that seems like, of course I would do that, but you'd be amazed that sometimes when you're in the process of purchasing a home, it's exciting. Maybe there's some exciting things going on in your life. Hey, we're about to have our first baby. We're about to get married. My girlfriend doesn't know yet, but I'm about to get engaged. And all of a sudden there's this excitement, and you forget, like, holy crap, the Macy's bill. And trust me when I tell you that if you're someone who's sitting there with like a 780, nice high FICO score, and you just go late on a Macy's bill, that'll drop you 80 to 100 points, 130 day late. So you got to be real careful and diligent while you're in this process. Okay. So you want to be careful about that. Keep your current job, if possible, right? And income, and contact us right away if anything changes. Now, look, that doesn't mean you can't change jobs, but I don't want you to go from like working for Deloitte. Is that who you were? Yeah. I don't want you to go from being a CPA at Deloitte to say, I want to be a salesman at Cross Country Mortgage because I'm a commission guy and he's a salary guy. That don't work anymore. So we don't want to do that, right? Have all your important documents handy, and I'll show you a list of that later. Okay, here's a don't. Don't make any major purchases, right? This is the craziest thing, but One of my favorite stores to shop at right around this time is the Fortunoff's outdoor backyard store, right? And they got really cool stuff in there. Half my backyard has got something from Fortunoff's. You know what the crazy thing about Fortunoff's is? They'll let you finance that for 0% interest for a long time. Defer the payments, you're good to go. If you happen to be all excited, we're going to get our first house and it's 3 weeks before you're closing and you go, hey, honey, look at this. And you buy all of your patio furniture and you finance it. Hey, there's no payments for 2 years. Guess what's going to happen? Right before you close, we do another pull of your credit, just a soft pull. And we're going to see this thing called an inquiry. And the inquiry is going to be from Fortunoff's or whatever bank they use. And we're going to investigate. And you can either choose to lie, which you don't ever want to do, or you're going to come clean and say, oh yeah, we just financed furniture. And then everything we just did has to be put on hold until we requalify you to make sure you qualify. So you could change the whole outcome of your loan process. Okay. So we don't want to purchase anything. If there's that good of a sale, let mom or dad or your brother and sister do it and then pay them back. Okay. Don't apply for new credit accounts. Don't close existing accounts for the reasons I just said. Don't close your credit cards and never co-sign for someone else, especially if someone you don't really know that well. Don't make large cash deposits into your bank account. If you make a cash deposit because you sold old baseball cards, I don't even know if people do that anymore, or maybe you had some collection that someone wanted, or you sold a vehicle even. If you don't have a proper paper trail for where that money came from, that's a red flag. That could be a problem. Don't spend your down payment and closing cost money. That's kind of obvious, but some people are, "Oh, this is too good to be true. I mean, I love this artwork." Don't plan a vacation during your loan process, right? I may need you to, and you'll be spending money anyway. So let's start with, there's 2 parts. Just take a picture of that one. And again, I know some of it's kind of common sense, but I think just having that, and then if you ever do these and I say, take out your phone, I told you so. I don't want to do that. Could I email? Yeah, if you email me, I could email you. Not the whole thing, but I can email you the slides you like. Yeah, for sure. Here's a couple of more don'ts. Some of this might be a little redundant, but here's what I'm going to tell you. Do or don't. I would say to you, until you actually meet with somebody like me or whoever you might be working with, which is me, just try to pay for now the minimum on your credit cards. Because if you don't have enough money saved, I may say to you, look, I don't care if you got a $5,000 balance on your credit card. Don't spend $5,000 cleaning up the credit card balance. I'm only looking at the monthly payment associated with the $5,000. Maybe we need the $5,000 to finish paying your closing costs. And now we push your purchase 4 more months down the road. Keep a paper trail of any funds you move in and out of accounts. Best thing to do is don't move money in and out of accounts, right? Notify us of any changes to your finances. We had unfortunate medical bill. Let me know. Notify us of any travel plans. Try not to do that, right? Don't cancel credit cards. I'm going to reiterate that. Don't take out any cash advance on your credit cards because that's borrowed money to borrow more money, right? Don't co-sign a loan. Don't take any new debt on there in process like that furniture I mentioned to you, okay? And don't change or quit your job without having another job lined up. Common sense, but truth be told, you'd be amazed. Yeah. Yeah, yep. We always go back 2 months prior to contract. If you're going to do something, do it now. And by the way, let's say you did have a large deposit, but it was because you won an inheritance or you had some windfall of an insurance policy or some, settlement. As long as you can paper trail that, that's fine. That doesn't matter. It's just it's like, hey, there's certain people, and there's less and less of them now, who like to see their money. So they cash their checks, spread it out on the bed, and they put it in their safe deposit box and they say, it's time to buy a house. Okay, let's dump that in the bank. No good. That's a problem. All right, red flag. All right, so market's crazy. So I say to you many times, I've said to you tonight, marry the home, date the mortgage. So another way to say it is buy now, refinance later. You come to me for your first home. You've been nice enough to trust me. I'm going to give you a $1,500 credit when you refinance towards your closing costs. Okay. Quick checklist of the things you typically are going to need. Maybe you take a picture of that too. Okay. Typically 30 days of pay stubs, 2 years tax returns, 2 months of bank statements, photo ID, credit card, doing a credit check. Okay. This is my team. Joe's in the back. Nick is behind the, Matt is behind the scenes doing all my, he's doing all my marketing. Matt is my marketing director. He's great. Nick is not here tonight. He's worked, comes in early. And that would be me about 5 years ago. What are you trying to show me there?
Okay, the home buyer's guide, the do's and don'ts are all.
Oh, there you go. There you go. Okay. So in your packets that I gave you, the do's and don'ts are in there and the home buyers in that home buyer's guide. Yeah.
Yep.
Okay. And yeah. So if you need to contact me tonight, you use the QR code. Otherwise, I think most of you know how to reach me. All right. So that will conclude tonight. Okay. Enjoy the warm week. And I'm looking forward to talking to you. Make sure you reach out to me tomorrow. Okay.